Welcome to the deep dive. This is where we take all that complex financial news, those dense economic reports, market analysis, and we try to turn it into clear, actionable understanding. And it's all tailored for you, our listener.
That's right.
So today, our mission really is to unpack this recent, pretty monumental surge we've seen in the stock market. We're going to dig into the forces that have, well, propelled the major indexes to new all-time highs just this week, all based on the sources you've shared. And the core question is, how did the S&P 500, the Nasdaq, the Dow, how do they all hit these unprecedented levels? And maybe more importantly, what does it actually mean for you?
Exactly. And our goal here is to really connect those dots for you. Look at the corporate earnings reports, look at the global trade developments, those broader economic things like inflation, interest rates,
Right.
and try to show the full picture of this current market rally.
Hey.
We really want to go beyond just the headlines and give you that deeper context, the implications that, really matter for how you see things.
Okay, so let's dive right in, because the numbers this past week, well, they've been pretty extraordinary. You couldn't really miss it if you glanced at the news.
No, definitely not.
The S&P 500, the Nasdaq Composite, the Dow Jones Industrial Average, all of them hitting new heights, shattering records, really.
Yeah.
Just look at Friday. The S&P 500, it closed up, what, 0.4%?
Yep. A solid gain.
The Nasdaq climbed 0.3%, and the Dow jumped about 190 points, also up 0.4%.
Strong across the board.
But here's the really striking part, I think. All three indexes, they hit new all-time intraday highs during Friday's session.
Right. Simultaneously. That's the key.
Exactly. Simultaneously. It wasn't like one was dragging the others. They were all pushing into uncharted territory together. It shows, widespread momentum.
Yeah, broad strength.
Yeah.
Not just isolated pockets.
And this wasn't just a Friday thing, right? The whole week showed the sustained upward trend.
Absolutely. Consistent movement.
The Dow was tracking for, I think, a 1.3% gain for the week. Nasdaq up 1.1% for the week. And the S&P 500, which is often seen as that broad market barometer,
Yeah, the big one.
it was pacing for a 1.5% increase over the week. So it's not just a blip. It feels like something more solid is happening.
Definitely feels that way. It suggests real underlying strength.
And the frequency of these records is just, well, it's something else. Get this. Thursday was the S&P 500's 13th record close of 2025.
13. Wow.
And four happened this week.
Just this week alone. That's incredible momentum.
Think about the psychology of that for investors, seeing new milestones almost daily. And the S&P closed above 6,300 for the first time ever on Monday.
Another big psychological level breached.
Meanwhile, the Nasdaq, it had 3 record closes this week too, and it broke through 21,000 on Wednesday. It's just been milestone after
It
milestone.
really paints a picture, doesn't it? A very strong, very bullish picture right now.
It does.
And it's so important, like you said, for us and for you listening, to look beyond just the daily ups and downs. The real story here is that series of record closes
Right.
across all the major indexes, hitting those intraday highs together. It just speaks volumes about market sentiment, about the momentum building up. It suggests, a fundamental shift.
A shift in confidence, maybe?
Exactly. A significant and seemingly growing confidence among investors. It suggests they're not just testing the waters anymore. They're committing capital.
With conviction.
With conviction, yes. Believing in the future prospects of these companies and maybe the economy more broadly. The perceived reward seems to be outweighing the perceived risk, at least for now.
And it feels broad-based, like you said, not just, a few tech stocks pulling everything up.
That's a really important point. It doesn't feel like one of those narrow, maybe speculative rallies we've sometimes seen. You're seeing strength across different sectors. Tech, yes, but also telecoms, financials, industrials. It suggests a more fundamental reevaluation of value.
Okay, so that brings us to the core question, the why. What are the fundamentals, the actual underpinnings needed for this kind of consistent, powerful upward drive? Is it just momentum feeding on itself? Or is there something, deeper, more tangible going on?
That's exactly what we need to unpack. Because usually for markets to sustain these kinds of highs, you need strong fundamental reasons, not just fleeting optimism.
Okay, let's unpack it then. The market's smashing records. Why? What's the fuel?
Well, the sources are pretty clear on this. One massive driver seems to be a really strong earnings season.
The company reports.
Exactly. Companies are just consistently beating expectations. It seems to be the primary catalyst right now.
And not just by a little or just a few companies.
No, that's the thing. It's widespread. Look, FactSet data shows that more than 82% of the S&P 500 companies that have reported so far have beaten Wall Street's earnings expectations.
Wow, over 4/5? That's huge.
It's a staggering number, really. Think about what that signals. It tells investors that corporate America is, well, maybe healthier or more resilient than analysts thought.
Yeah, that's a powerful message.
It really is.
And we're seeing specific examples driving this too, right? Like Alphabet.
Yep, Google's parent company. Better than expected earnings, strong cloud performance, ads bouncing back. The stock was up, what, 4% for the week?
Yeah, a solid jump for such a giant. And it wasn't just tech. You mentioned Verizon too.
Right, the telecom giant. They surpassed expectations too, especially on subscriber growth, managing costs. Their shares jumped 5% this week.
So strong performance across different sectors, influential companies showing real health.
Exactly. These aren't just tiny beats. They're solid performances.
Mm.
And that importance of beating expectations, especially when it's so widespread, well, it can't really be overstated.
Why is beating expectations, even by a bit, so significant?
Well, it signals that the company's underlying business, maybe demand, maybe efficiency, maybe new products, it's stronger than the experts predicted.
Okay.
So when over 80% of companies are doing that, it paints this picture of, fundamental corporate health, economic resilience. It's not just abstract data. It's a tangible, positive signal rippling through the market.
Which leads us to this idea of favorable fundamentals.
Precisely. That's the term strategists use. It's not just jargon. It's about the core economic conditions that let businesses thrive and where stocks, have room to grow.
And Terry Sanvin at U.S. Bank Wealth Management summed this up?
He did, yeah. He told CNBC, basically, the bull market lives on, supported largely by favorable fundamentals. He's saying, look, this rally has strong legs under it.
Okay, so what are those fundamentals? According to him, he broke it down.
He did, into three key pieces, really. First, and this is huge right now, inflation is stable.
Stable inflation. Why is that so critical?
Well, for you, for everyone, it means your money isn't losing value rapidly. It gives predictability. Businesses can plan, consumers can budget. Imagine trying to operate if costs were swinging wildly month to month.
Yeah, impossible.
Stable inflation reduces that uncertainty. It lets businesses invest, plan, hire, and, crucially, it takes pressure off the central bank, the Fed, to hike interest rates aggressively. Which brings us to his second point. Interest rates are range-bound.
Range-bound, meaning not jumping all over the place.
Exactly. Staying within a predictable zone. Think of it like a steady pace, not a volatile sprint. This provides stability for borrowing costs.
Like for mortgages or businesses wanting to build something new?
Precisely. If borrowing costs are predictable, it encourages those bigger investments, that economic activity. People and companies feel more confident making long-term commitments.
Okay, so stable inflation, range-bound rates. What was the third pillar?
The one we just talked about. Earnings are trending higher.
Yeah.
Companies are beating expectations. Profits and revenues are growing. It shows the businesses themselves are strong.
Right.
So you put those three together, stable inflation, predictable rates, rising earnings,
Right.
and according to Sanvin, you get
A favorable backdrop for stocks to trend higher.
exactly. It fosters what we call a risk-on bias.
Risk on, meaning investors are more willing to buy stocks instead of safer stuff.
Pretty much. The general feeling is that the potential reward in stocks outweighs the perceived risks. So capital flows towards equities, towards growth. It's a psychological and financial force that can really sustain a rally like this.
And this ties into the Federal Reserve meeting next week?
Absolutely. The expectation is overwhelming that they'll keep interest rates where they are in that 4.25% to 4.5% range.
So more predictability.
Yes. And in investing, predictability is golden. It reduces uncertainty, lets people plan. It reinforces that range-bound interest rates fundamentalist Sanvin talked about. It signals that, for now, the economic foundation seems solid.
Okay, that paints a really clear picture on the domestic side. Strong earnings, stable macro conditions. But you mentioned global trade, too. That's adding another layer.
It is, yeah. And this is where it gets particularly interesting because it's happening despite some ongoing uncertainties. It shows the market's ability to process complex news.
So what's been happening on the trade front? There was news about Japan.
Right. President Trump announced what he called a massive trade agreement with Japan. And notably, it includes these 15% reciprocal tariffs.
Reciprocal tariffs, meaning both sides apply the same duties, aiming for balance.
Kind of, yeah. Instead of one side imposing tariffs unilaterally, it's framed as a mutual agreement on duties. It affects a lot of sectors, and the idea is it removes some of that trade friction that was clouding the outlook.
Okay. And Indonesia, too.
Yes. The president also mentioned the U.S. and Indonesia have settled on a trade agreement framework.
A framework, not a final deal yet.
Not final, but it's a really important signal. It lays the groundwork, shows a path forward, suggests both sides want to reduce barriers. That's usually seen as positive for global commerce.
And Trump expects more deals soon, before that August 1st deadline.
That's what he indicated, yeah.
Are getting some
And then adding to that, the European Commission President, Ursula von der Leyen, she posted on X, confirming she's meeting Trump in Scotland on Sunday.
specifically to talk trade.
Specifically trade, which, could potentially lead to something significant between the U.S. and the EU, two massive trading partners. That would be another big dose of optimism.
How do these kinds of deals, or even just the talks, affect the market so directly?
Well, think about it. Before this, trade disputes, the threat of tariffs.
Right.
That's major uncertainty for companies, right?
Yeah.
Disrupts supply chains, makes planning hard, hurts profits.
Yeah, definitely.
So when agreements are announced or even just seriously discussed, it reduces that uncertainty. Companies feel more confident investing, expanding. It boosts optimism about global growth, which feeds right back into that risk-on sentiment we talked about.
And that idea of reciprocal tariffs, is that seen differently than regular tariffs?
It can be. It implies more of a negotiated, maybe balanced approach rather than just punitive measures. For businesses, predictability is often key. Even if there are tariffs, if they're stable and understood, companies can adapt. It's the sudden, unexpected shifts that cause the most disruption.
But it's not all clear skies on the trade front, is it? Sandman mentioned uncertainty still remains.
That's the crucial counterpoint, yes. He specifically said, tariffs remain an item of uncertainty, and commentary from companies still reflects this ongoing uncertainty. So even with good news, that underlying anxiety hasn't totally disappeared. Progress, yes, but the potential for friction is still there.
So how has the market managed to climb higher through that uncertainty? Sandman mentioned geopolitical risks too, right? Russia, Ukraine, Israel, Iran.
He did, and that's what's fascinating. He pointed out that the market has basically absorbed these major geopolitical challenges without a significant negative impact on its overall trend.
It's like investors are compartmentalizing those risks.
It seems that way, and Sandman brings it right back to the fundamentals. He said, in our view, it gets back to the strong fundamentals, namely, inflation appears to be under control.
Ah, so this domestic strength is overriding the external worries.
That's the argument. It suggests that while those geopolitical risks are real and significant, impacting energy, supply chains, regional stability, the underlying U.S. economic health, driven by that stable inflation, predictable rates, strong earnings, it's just so robust right now that it's outweighing those external pressures.
So the market's basically saying, yes, risks exist, but our core engine is strong enough to handle them.
That seems to be the message it's sending. It shows remarkable resilience, a deep confidence in the U.S. economy's foundation, allowing investors to stay risk-on, even with worrying headlines.
That's a really powerful point about compartmentalizing. For you, the listener, seeing headlines about global risks, it might seem strange the market can just push through. Does that tell us something about investor psychology right now? Is there a point where those risks do break through?
That's a great question. It's not really that investors ignore the risks. It's more like they're actively weighing them against the strength they see in the fundamentals.
Kind of risk prioritization.
Exactly. When inflation is stable, rates are predictable, earnings are beating expectations, that's a tangible growth story. Geopolitical events, serious as they are seen more as external shocks that, for now, haven't fundamentally derailed the core U.S. economic trajectory.
But there is a breaking point, theoretically.
Oh, absolutely. A major energy supply disruption driving inflation way up, or a conflict escalating to directly hit major trade routes or industries, that could definitely shift sentiment. But right now, the market seems to feel these conflicts are relatively contained in their direct economic impact on most U.S. companies.
So the strong balance sheets, the diversified operations of these big companies act as a buffer.
That seems to be the perception. It suggests confidence that companies can navigate headwinds, making investors less likely to panic, maybe even inclined to buy dips if they happen. It's kind of calculated resilience.
Okay, that makes a lot of sense. So looking ahead then, phenomenal week behind us, resilience holding. What's next? What should we and you, the listener, be watching for?
Well, things aren't slowing down. Next week is actually the busiest week of earnings season.
Oh, really? So a lot more data coming.
A ton more data. Over 150 S&P 500 companies are reporting. That's a huge chunk of the market, giving us updates on their health, their profits, their outlook.
And some big names in that batch.
Huge names, including members of that group people call the Magnificent Seven.
Ah, the big tech drivers.
Yeah.
Apple, Microsoft, Alphabet, Amazon.
NVIDIA, Meta, Tesla. Yeah. Their performance can really sway the whole market. And next week, we're expecting reports from Meta Platforms and Apple specifically.
Wow, so their numbers, their guidance, everyone will be watching those incredibly closely.
Absolutely. Their significance really can't be overstated. If they continue this trend of beating expectations, it powerfully reinforces the whole positive story, fuels that risk-on bias. Investors will be looking for strong demand, efficiency, optimistic guidance, especially around things like AI.
But the flip side,
Yeah,
what if they miss? Or sound cautious?
right. That could introduce volatility, challenge the momentum. A miss from Apple on iPhone sales, for instance, might signal consumer softness. Weak ad revenue from Meta could raise questions about that whole market. These reports can trigger major reevaluations.
And we also have the Fed meeting next week, too.
We do. And as we said, the expectation is for rates to hold steady, 4.25% to 4.5%.
More stability.
More stability from the rate decision itself. The market likes that predictability. But the key will also be the Fed's statement, the commentary from the chair. Any subtle shift in tone about inflation or future growth could signal future policy changes, even if rates don't move now.
So you combine that expected Fed stability with potentially more strong earnings.
And it reinforces that risk-on environment, right?
Mm-hmm.
Stable macro picture, strong micro performance from companies. Historically, that's often a recipe for continued market strength.
Okay.
But, this really raises a big question for you, the listener, to think about. With all this momentum, with these big events coming up,
Yeah.
what's the next big catalyst or the next big challenge?
Right. What could push it higher or knock it off course?
Exactly. Will it be more earnings beats, a new trade deal, an AI breakthrough, or could it be a jump in inflation, a Fed surprise, a geopolitical shock that finally breaks through that resilience we talked about?
It's that constant interplay, isn't it?
It really is. Corporate results, macro stability, global politics.
Mm-hmm.
It's always evolving, always shaping the landscape. It's an ongoing story.
Okay, so let's try to wrap this up. What we've seen in this deep dive is this powerful mix, right? You've got incredibly strong earnings. That 82% beat rate is just amazing.
Mm-hmm.
Plus stable economic signs, inflation under control, interest rates behaving, and even some progress on trade deals reducing uncertainty.
Yep, all working together.
And all that combined has propelled these major indexes to new all-time highs. The sentiment seems clear. The bull market lives on, and it feels like it's standing on pretty solid ground on those fundamentals.
It does. It's been quite a run. And understanding the why behind it is key.
Yeah.
And the big takeaway, I think, is seeing how the market's path is being powerfully guided by that underlying economic health, that corporate performance, even when there are serious global tensions and trade uncertainties swirling around. The fundamentals have just been that compelling,
Too strong to ignore.
pretty much. Which leaves us with a final thought for you, the listener. As we go into this huge earnings week, as trade talks continue, how is this market resilience going to be tested next? What new fundamentals or maybe unforeseen challenges might emerge to change the direction? After hearing all this analysis, what really stands out to you about this incredible market run and where it might go next?